In this video, I'm going to talk about how to prepare a statement of business or professional activities for somebody who's self-employed, and this could also include professional income. And so I've got the form here that I got a fillable copy of from CRA, and I'm just going to go over it. I'm not going to fill in the whole thing. I'm just going to show you how it works. So first, obviously, we're going to put your name, you're going to put your social insurance number, and this is just if you're filling your T1, your personal tax return in, this is just something that's going to go in your T1, in your personal tax return. It's just another form. So the form itself is called a T2125. So if you've entered your SIN in your personal tax return, it's going to automatically show up here. But anyway, so you're going to put your name, your business number. If you've got a separate business number, for example, a GST number, you put that there, and you're going to put your business address, which many times might be your home address. But if you work out of a separate location, you would put your business address, and then you're going to go with fiscal period, which would be the calendar year, 9 times out of 10. So it's going to be the calendar year, and you're going to indicate whether this was your last year of business, and you're going to put your main product or service. So for example, if you're selling shoes, you're going to put shoe sales here, and then you're going to need to look up the industry code for shoe sales or whatever your business is, and you can look that up. But it's going to be a 6-digit number that goes here, and you can just Google that to find out what your specific code is. And then counting method most of the times is going to be the accrual method. This is only for commission people, so don't worry about that most of the time. These will not affect most people either. I'm just going to skip over them. And then next, you're going to put your number of websites. So if you've got some websites that you're earning income from, in the example I said with shoe sales, you could have a shoe sale website, and then that's when you'd put the number of websites you have, and you'd put the domain address here, and then you'd put the percentage that each website had, that percentage of income you make from each website. But anyway, just going to skip through that part, and then we'll go into, so you either fill out A or B. If it's business income, you're going to fill out A. If it's professional income, you're going to fill out B. So if you're a lawyer, for example, you'd fill out B. If you're shoe salesperson, if you're selling shoes, your business is selling shoes, then I'm gonna go with A. And so you fill out the gross sales, including GST. Then you're going to put the GST amount that you collected. Then you're going to put your adjusted gross sales, which is basically gross minus the GST you've collected, equals your net sales here. And then it's all gonna, if you're using software, it's gonna auto-populate. Hopefully you're using software. And just be aware that if you're using software, you want to be careful which you choose between these two. For example, if you've received a T4A and you've entered it into the part of the tax software that accepts the T4A slip, and you can indicate whether this is going to go to a profession. If it's professional income, it goes in one line. If it's business income, it goes in the other line. And you just want to make sure that it's flowing through the tax software properly. And then we're going to go with all the different expenses. So starting with cost of goods sold. So, you've got your gross business income here, and then you've got less cost of goods sales. So, in my example of shoes, maybe I started the year with 0 shoes, and then I bought some shoes, and then I ended the year with, say I bought $1,000 in shoes, and I ended the year with $500 in shoes. So then my cost of goods sold would be 1,000 minus 500. So I'm looking at $500 in cost of goods sold. Anyway, so we've got your gross sales minus your cost of goods sold. It could be also including direct wage costs, subcontracts, et cetera, et cetera. Then you've got your gross profit. And then next you're going to enter all of your different expenses. So there could be more than what's here, and those would go under the other category. But these are going to be most of your common expenses. So just make sure you're entering them in the right line. So advertising, meals and entertainment, etc., etc., etc. Like I said, if they don't fit into one of these categories, you can add them in under the other, and then you have to specify what it is. And also, just a couple notes here. There's going to be some things that are going to link in from other areas. For example, motor vehicle expenses. You're going to have a separate worksheet that you enter your motor vehicle expenses on. So it's going to have your lease costs or your cost of finance, your fuel or your electric charges if you've got an EV, and then insurance, et cetera, et cetera. Anyways, that, and then what you're going to do is, in most cases, you're going to multiply that by a percentage because most people don't use their vehicle 100% for business. So say you've got a regular car that you're using just here and there, maybe it's 10%. So then you're going to take all of your expenses relating to your motor vehicle and then multiply that by 10%. And that's the amount that's going to end up here on this line. And it's important to keep a mileage log. So if you're, in my 10% example, you're going to make sure you don't want to just ballpark it. What you want to do is you want to actually track your kilometers. So if you drive to, a warehouse to buy some shoes that you're going to then bring over to your, or you go to your distributor and you buy some shoes and then you bring them to your warehouse, and then you're driving from there to meet with a potential purchaser. All these trips, you're going to want to keep track of those, but then at the same time, you also want to make sure you're keeping track of your personal trips, because you have to calculate your total kilometers, and then so you take your business kilometers divided by your total kilometers, and then you've got your percentage that you apply against your expenses. And then, so this capital cost allowance line here, this is basically another word for amortization or depreciation. So this is for all of your assets that you're buying. So maybe you've got a computer. You don't expense that computer all at once. Or furniture, for example. Furniture is going to last for a while. It's going to last for multiple years, hopefully. So there are certain rules around each type of equipment. So furniture is class 8, which is a 20% capital cost allowance each year. So except for the first year, which is half. So every class has a different percentage. So you're going to want to make sure you look up what percentage the type of asset is that that you purchase for the business, and keep track of it on a schedule. So if you're using software, again, that will keep track of it for you and apply the right percentage, assuming you choose the right class. But you definitely want to figure that out. Make sure that you're putting things into the right class, and keep your receipts for. In general, you're going to want to keep your receipts for 7 years. But when it comes to assets, you're going to want to keep them even longer, because that asset is going to depreciate over longer than just that one tax year. So you might be depreciated an asset over many years. Well, you want to look back 7 years from the last time you depreciated that asset to sort of make sure you're keeping your receipts for that for a long enough period of time. So once we've taken all of our expenses, we get our net income before adjustments. And if you're splitting this with, if you've got a partnership, then you've got some income, and maybe some income coming in from that. That comes from here. These are not as common. I'm not really going to focus on stuff that's not super common, because I want to keep this video relatively short. And then you've got your business use of home expenses, and I'm going to go down to the part of the form that talks about that. So here's the part that says that calculates the business use of home. So this would be something like a home office, or if you use part of your, say, garage for storage. So then what you're going to be allowed to do is take a percentage of your home office and or a percentage of your home expenses and apply them to your business. So for example, say you've got a home office that's a typical office. Maybe it's 100 square feet and your house is 1,000 square feet. So then you're going to take 10% of all of your costs relating to the house and apply them to the home office for a deduction. So here we've got the typical expenses like heat, electricity, insurance, maintenance, mortgage interest, not the principal payments, just the interest, property taxes or other. So if you're renting, for example, you'd go with other here and you'd put rent, and you wouldn't have mortgage interest or property tax, but the other ones may still apply to you if you're renting. But anyway, so then you've got you're going to total it up, and then you're going to back out the personal use. So if you're using 10%, so 10, if you're using 10% for business, 90% is going to get backed out. And so say your total here ends up being $10,000 and you're backing out 90%, so you're backing out 9,000. So then the business use of the allowable portion is only $1,000. And that's going to come down, of course, if you, one side note, you can't use a home office to create a loss or increase a loss. So if you had a loss last year and you had a home office expense, it's good to still claim it. It's just going to get carried forward. And so maybe you, if you were running at a loss last year, but you had the $1,000 from last year, maybe you've got $1,000 to carry forward, and that gets added to, let me just do the numbers here. So when we said 9,000 was the personal portion, so then 1,000 becomes that. So maybe we might have, then we're going to have $2,000 in expenses because 1,000 was from last year, 1,000 from this year. So, and this is, like I said, you can't use a home office to create or increase a loss, but it's good to still claim it so that when you do actually have profit in the business, then you can use that home office expense. So this number here is going to come up to be deducted. You can see here amount from 7P, so that's going to go here. So it would be $1,000, or if you had a loss last year, maybe it'd be $2,000, whatever. But anyways, that's going to carry up to here. It's going to be a deduction for you, and then this net income here is going to get reported on your on your personal tax return as your net income. So you can see where it tells you to put that. So business income is going on line 13500, professional income 13700, and commission income is 13900. So that number here is going to go to one of these three lines on your personal tax return. And the self-employment income or business income or commission income is going to be taxable at your marginal rates. And you can use an RSP deduction to decrease your taxable income, but or things like that. But this is going to get added to your personal income. And that, let me just show you a couple other things here. So this is where you would, if you are claiming a depreciation or a capital cost allowance claim, this is where you'd be entering things in. So you'd be entering in your cost of addition. So you bought a computer this year, for example, you'd enter that in, say it was $500. You'd enter that in, and then you'd take the appropriate capital cost allowance. And then the amount that would be left over is called your UCC at the end of the year. So that is going to be what gets carried forward to your next tax year, and then you can deduct CCA against that opening balance. Let me see what else we have. So here's your motor vehicle allowance detailed page. So you're going to put in your kilometers you drove for business, total kilometers. That's going to get you a percentage. Then you're going to put down all your different expenses, and CRA is updated to show a line for zero emission vehicles. So maybe your electricity charges that you're using rather than fuel and oil. And let's see what else we have. So we have lease expenses. So when it comes to leasing your vehicle, it's not as simple